This video is going to be about Conagra Brands. I'm continuing my search for a nice dividend stock to invest in, and I've flipped quite a few rocks, and I've stumbled across Conagra, and it looked interesting because it does seem like, we'll talk in a minute, like a stable business, as a food business, like a consumer staples business, which does look undervalued right now. The dividend yield is higher than average and the stock price is down, and like a big moat maybe business. So it looked interesting, so I decided to do a deep dive, and these are my conclusions. So just a quick overview. Conagra Brands is a food company. They have all those brands of food, packaged food products, from beef jerky to whipped cream. Their mainly sell through supermarkets. Their biggest customer is Walmart. And we can see here the categories of the foods they sell, produce and sell. And the biggest category right now is frozen foods, where it's mostly, I think, like pre-made meals. They have a lot of single-serve pre-made meals that are frozen and you only need to heat and it's ready. But I think they're also or either they're already in or they're getting into the frozen vegetables and fruits also market. So yeah, so it's a company that has been around for a really long time. I think it was established in like the 40s or something like that. And it went public in the 70s, so it's been around for quite a while. So the main story is the growth story that the company is selling us and wanting us to believe. So the growth story of the company of the late years have been that they're since 2015, they've been like rebuilding the company and changing their business model, and they pretty much sold a lot of the brands they were holding at the moment and a lot of sections of the company, and they're like made the transformation to be focused more on like specific, laser focused on specific brands, like brand-driven company. So they took a few years to pretty much like scale down the company and just leave their winning brands. And then they took a few years. That's what they're saying, yeah? They took a few years to build and establish the new infrastructure for the new model. And since then, the company has been growing really nicely, where they really put focus on the existing brands, innovating and releasing new products and working on what is working. So that's the story. But of course, we'll see something different soon. So if you look at the investors' presentations from for the past few years, you see those graphs when they show the growth in different categories. It's not just this category, it's a lot of categories when they have like a 11% growth in the category since they've been transforming the company. This is an example of how they show the cohorts of the new products they launched in the last few years. And we see how they're only the products that have been launched, how much they're making, and that the company is growing, and we can see the growth. But, of course, the reality is, I'm not sure the growth is there, and this is the case I will show in this presentation. Basically, what they had is they had a big acquisition in 2018 of a Pinnacle company, so that added to their growth, to their revenues. What we see here, to their revenues, and then COVID hit. And when COVID hit, people were staying home and buying much more groceries and not eating outside. So this gave a big boom to the sales of the company. To the volumes of the company. But the main point I want to talk about is that since COVID hopefully is behind us and people got back to working and eating outside, volumes has been constantly down, and the growth that we see here is the growth in revenue where the main drive, maybe the only drive of this revenue growth was the price increases, because there was, of course, as we know, high inflation. So Conagra was raising prices like all of its competitors also, and all of its suppliers. So its costs were also very much up. So yes, we see a growth in revenues, but it's an inflationary environment, and it has been raising prices while the volumes has been down in 2022 and 2023, and they're still continuing the downtrend, which they haven't still reversed. We'll talk about that in a minute. So what we're saying is, yes, the revenues are growing because of the inflation, but the margins are pretty much stable. It has been a little bit volatile, but I don't see a specific trend in the margin. But the sales volumes have been down, so this growth story is not really there for the past few years. Now, the company, of course, is not denying that. It's just that the presentations are a little bit not showing the complete picture. So yes, so the volumes have been down for the last few years, and the story is that there are macro headwinds, that people are spending less, and the company really feels it. So here are the list of how the consumer behavior is changing, has been changed during the last quarters, and that have affected Conagra and its competitors. So we see that people spend less money on discretionary items, which single serve meals, frozen meals, of course, they're more discretionary than buying your own ingredients and making your own meals. So it's going to be more costly. Of course, buying single serve is more expensive than buying bulk, and they're using more leftovers and more inventories. So so consumers are buying less and the volumes are down. So if we look really at the volumes trend for the last few years, again, like I said, there was a boom during the COVID period, and then volumes in 2022 have been down 4%, and in 2023 they've been down 8%. So the growth is not really there, the growth story, and we'll talk soon if that's maybe some secular trends or if it's really just macro. We don't really know. I don't really know. We see here the last few quarters, the volumes trend has been even worse and been really down, and it's still negative. And then they started this intense promotional activity. So I think their expenses are also going to be up, their C&A expenses on promotions. So now they managed to a little bit reduce the decrease in volumes, but the trend is still negative. So trying to think what could make the volumes, why possible scenarios where the volumes have been down for the last few years and keep going down. So the possible reasons for that could be, first of all, the correction after the COVID boom. So they had the boom, the increase in revenues because people were staying home, and now they're not staying home anymore. So it just corrects itself to the normal level. Like if there hasn't been COVID, they had their steady, slow growth or no growth, and it's been stable, but the declines are from the COVID boom era. So that's one explanation. The other ones are the macro headwinds that I've been talking about, that people are spending less and more mindful of their budgets and everything we talked about already. But there could be also negative secular trends, long-term trends that are affecting Conagra, and that's the big risk in my mind. Of course, the big risk, the big danger is that those trends are not necessarily only temporary, and it's not just macroeconomic issues that are facing the company, that the company is facing right now, or the correction from like macro things like everything that happened with COVID. Those could be also some dangers, some risks in the market itself, and some long-term risk for Conagra. So, for example, there is a speculation that Americans could consume less calories from now on or for the next decade, partly because of some weight loss drugs or because of changing consumer behavior. I think the biggest risk are the private labels, where the supermarkets are introducing their own versions to the popular brands, the popular products that are selling well. Of course, they can reduce prices and promote, give the best shelf location to their own products. I know I have been using in many different countries. I've been buying private label supermarket brands, and mostly I love them. They are usually coming even from the same factory. So I think this is probably the biggest risk for Conagra. It's not a big secret; everybody knows that. So it could be also affecting volumes. I'm not saying that's the explanation for the whole decline in volumes, but it is a risk that is here to stay for a long term and might pressure the margins and the volumes of Conagra long term. So of course there could be competition not only from the supermarket private label, from other brands, not the supermarket white label brands, but other brands that are also pressuring Conagra sales. There could be a trend where people eat healthier, and if we look at the brands that Conagra has, it's mostly not so healthy food. So if there is a trend where people in general, like as a group, begin to eat healthier, I think Conagra would definitely feel it in its volumes, in its sales. So yeah, it might be that the brands that have been there for so many decades, it's not I wouldn't take so much for granted that they're here to stay for more decades. Of course, some of them will, but it's enough for a few of the biggest brands to be affected by those secular trends, for the volumes to really be affected for the company, and so the margins, and so of course the share price. So if we look at this graph when they showed all their new products and how much they are making, it seems like it's, at least in the last couple of years, it's not enough to offset the reduction in volumes in the sales of other brands, or the same brands, I don't know, where we see here there is a reduction in the volumes. So it's a nice story, but overall, what I would say is the growth is not really there. And if we look at the earnings, this is the last few years, and those are the estimates for next years. We see there is really not so much growth story here. And of course, one could argue that it was supposed to be there, but because of the current macroeconomic situation, we don't see it. And once the trends reverse, and maybe interest rates are down, and consumer confidence is back, then we will see the growth, maybe or maybe not. But if we do look longer term, we see that really the company did nothing for all those growth years, both in terms of its share price and the return to shareholders. And we see that currently the estimates are there is a no growth story here. So those are going to be my assumptions looking forward, that this is a company that is not growing. It might even decline because of the reasons I talked about. It might be able to grow and increase its brand recognition and introduce new products and innovate and everything that it promises on. It could happen, but I don't know. So right now what I see is a no growth story, not only because of the estimates, but because of the history. And just to mention also the Pinnacle deal, which seems that it did go really well, and it didn't really materialize the way they thought it would. And now this is why I used here the non-GAAP earnings because they're writing off big chunks of it. So we see that there is not really a good record of value creation for us shareholders, not me currently. So assuming this is a no growth company, but with a stable business, stable brands, it has been here for a really long time, maybe, and it has a nice dividend yield, which we'll talk about in a minute. So maybe it's still a good investment. First of all, I want to talk about the notion that it's a recession-proof company. I mean, of course, it's a food company, and the saying goes that everybody needs to eat, even in a recession. And then let's go, it's classic consumer staples company. But we're not even in a recession yet, and we already see such a big effect on the company's sales, on its revenues, or on its projections and estimates, and on the share price. So what would happen in a real recession with Conagra? That really got me worried. I mean, the reason I was attracted to it in the first place was because it seems like a recession-proof, nice addition to my portfolio. But right now, I'm not sure because, of course, not only Conagra feels changes in the consumer behavior right now. We see it in all types of brands where people are more tightening their budgets. But still, I'm kind of surprised at how much Conagra, the food company, feels it. And it turns out that although it's a food company, in the food universe, it is pretty discretionary because, as we talked about, people buy less single-serve frozen expensive meals when they're tightening their budgets. So it has that consumer discretionary characteristics, which we see really in action here already. And again, we're not even in a recession yet. So what will happen with Conagra in a recession? I'm not saying it's going to collapse. We'll soon talk about the debt where it might. But not because of I don't think the volumes will be so down that it might go under, but we do see that it's really affected in a recession. So moving to capital allocation, just to touch upon it, we see here that the return on invested capital is not stellar, but maybe for its food company, it's not stellar. Anyway, the company has a cash flow from operating activities of about 1.4 billion. After capex, its free cash flow is about 1 billion, and out of that, we see that 600 million are for dividends, which is a nice cushion. It seems like the dividend is pretty safe. And the rest of the capital currently, they're really committed to reducing their debt because they do have a high debt. They took a big debt to buy this Pinnacle company, which again did not go as well as they planned. And they got really leveraged, high leverage. So now they're trying to spend that extra cash flow to reduce the debt, and they're aiming to reduce their leverage ratio to 3.5%, I think. Yeah, but the debt is high. I mean, it sits on really low cash reserves. So we see that some big chunks of their debt is due in the next few years. And they of course, they're gonna need to finance that. And we already see that when they do, they're gonna pay higher interest rates on that with low cash reserves. Decreasing volumes. I currently have a pretty depressing credit rating from Moody's. So the situation with the cash and the debt is not stellar, really. So dividend. So the dividend yield is really high right now, and I think that's the reason a lot of investors are attracted to this investment opportunity. Because the share price is down, and they have been they have increased significantly the dividend in the last few years with a 10% growth rate. I'm not counting on that to continue this pace. We see they had when they spun off or sold parts of the company, they did reduce the dividend, but except for that, they have been growing it pretty much steadily. But that it's not like I can really ignore that, because the company has been zigzagging, I think, in its strategy, which it's okay to change strategy. And again, I'm not one to think that the dividend is like something holy you need to hold on to. If it was the right steps for the company, they should have done that. But I do think that something is not really stable with the model, with the company, with its strategy, where it spun off parts and then they bought parts. So it's, again, if they spun off, sold the bad parts and bought some good, profitable companies, then it's great. But I think there is a risk that this is a little bit of zigzagging will continue on. So the current dividend yield is 5%, which is of course nice. We talked about the payout ratio, which I think it's a little bit higher than that, really, like around 65%, I think, which is okay. Still, the dividend seems really safe to me. So just before we head to valuation, I want to talk about the normalized EPS and the gap EPS in 2023 was really low, down because of the write-offs on the Pinnacle deal and some impairment charges. So the normalized EPE, it seems, based on the revenues and how the first half of 2024 is going, it seems like it's going to be really similar to 2021 in terms of results, revenues and margins and profits. So I think the normalized, like the earnings power, EPS right now is $2.6. And again, assuming it's a no growth story and a company that is not growing, and this is the EPS I see for the foreseeable future, maybe with a little growth, but it also could decline. So this is what I am going to assume for the next few years, $2.6 of EPS. So taking that 2.6 EPS, the current PE ratio is around 11, which is historically low, really low. If I move myself here, we can see those are different ratios, and we can see that not all of them, but some of them seem really low historically. But the ratio was higher historically because there was some growth there, even if it was not exactly organic, but now the volumes are down, and we don't, personally, I'm not sure really it's absolutely temporary, and it seems like in the best case, I don't know if best case, but the probable case is that there's not going to be any growth. So I think a 10, 11 PE for no growth like stalwart company is really okay. I know the historical PE was like 14, and a lot of people count on it reverting back to the ratio of 14 and the price appreciation that would happen to that. It might materialize, but it might also stay in this lower level PE because of the no growth. So yeah, I think 10, 11 sounds fair. I'm not gonna calculate more than that for the fair value of the company. So I think it's pretty much fairly valued at this point. But with a 10 PE, that means 10% earnings yield plus 5% dividend yield. That's a pretty much nice return. Even if the company doesn't grow, the owner's yield is pretty much there. So it could be nice. It looks interesting. I'm not sure yet if I will commit to that, but so if I use Guru Focus for DCF, we also see in short that it's fairly valued. I put a 2% growth where honestly, I'm not, right now the estimates are not even 2%, they're like 1 and something percent. So that's already a little bit generous, but okay, 2%, let's say. From the current EPS of 2.6, like I said, we see that the company is fairly valued. So yeah, so my conclusions, I have pretty much said it all, but I think it mostly comes down whether I believe that the current declines in volume are temporary because of some macro economic conditions, the environment, or it could be some negative trends that will affect Conagra for the long term? And the answer is I don't know. Personally, maybe if that was more in my area of competence, if I would have more experience and knowledge in the field. But that's for me the biggest risk, and that's why I will not commit at least a big portion to Conagra. So yeah, I think that's the main risk. But of course, we also have the really limited upside because it's a no-growth company, and we see what the share price and the earnings did in the last many years. So there's not really growth here, and there's not a big upside here. There's not a real catalyst here for some kind of explosive growth suddenly. It does have high debt, low cash reserves, a low credit rating. So I don't know. It doesn't seem like such a quality company like it maybe looks on the surface. It is more recession sensitive than I expected, being a food company, but we again see the impact that a small movement in the consumer behavior already has on Conagra. So again, what will happen in a real recession? This is definitely not a screaming buy. I don't think there is a big opportunity here, even not a moderate opportunity here. It seems like there is not really a huge upside. And therefore, there's not really a margin of safety, like we see here. My price target is pretty much, again, with the current PE, I think it's fair. So on the other hand, the company does have a good cash flow, which as an owner you can count on for years to come. It does have a nice earnings yield and the dividend yield together. It's just something steady and quiet to have in your portfolio where the yield is there. It does have some pricing power, it seems, where it did manage to raise prices in the last few years, but then again, everybody raised prices. Of course, they cannot raise them as much as it likes. It has a lot of competition, again, also from the private labels of the supermarkets themselves. It does have currently historically good valuation, though there is the possibility that if it does manage to show back growth and the current headwinds are temporary, then the company would show some growth after that, and the PE really could revert to 14 historical average, but it could also go even higher where it has been before. So Again, the biggest question is whether the volume declines currently are temporary or is there something long-term. So if you think they're temporary, I think that definitely it's a good investment. As I don't know, I might commit a small position just to lock in that nice dividend, and which I hate myself for, because if there wasn't a high dividend here, I would never touch it. So that's a bad sign, really a bad sign. I need to think a little bit more about it. But yeah, I'm definitely not screaming buy. I will watch for maybe a better price. If it goes lower, then it would be a really nice opportunity, and then I would love it. So yeah, so those are my thoughts. Bye bye.